Hey everyone, and welcome to Tax Tuesday with the Tax Queen. My name is Heather Ryan, and I am here today to answer tax questions for you. I own the Tax Queen, and I support digital nomads, RV entrepreneurs, and other business owners that are working and traveling, working remotely, really, and traveling. So I did get quite a few, just several questions ahead of time. So I'm going to go ahead and jump into them. If you are here live, feel free to let me know and just send me some pop something in the chat. Tell me where you are currently. I'm currently in my van in just outside of Salt Lake City. So if anyone else is in that area, that's cool. And otherwise, I'm going to go ahead and just dive in. So first question is, I'm selling my park model in a leased park in Ohio, and I'm moving to South Carolina, perhaps in a sticks and bricks home or another rented RV lot. What would your suggestions be to save taxes? So there isn't like a one way to save taxes just because you're selling things. If this is your primary home, so the IRS gives an exclusion up to $500,000 if you're married and $250,000 for an individual taxpayer. So if you're making less than that on the sale of your home, then it is tax-free. So there's no tax savings just by selling and moving. There's no magic thing there. And also, do I need to pay Ohio on RMD? So RMD withdrawals is your required minimum distribution. So if you are taking out retirement funds at a certain age, you're required to take out a certain percentage. And if you remain an Ohio resident, whatever state you are a resident of, you are required to pay state taxes on retirement income. And that would matter. So if you move from one state to another, you could have a split year. Don't know any state that doesn't tax retirement funds at all. Sometimes they might not tax Social Security or certain pensions and things, but typically, if there's a state tax, you are going to pay state taxes on that income. And then lastly, this question has to do with how will this affect Social Security? So I'm not sure what you mean. How will this? What is this? It's not well defined here in this question, but let's just kind of go over how Social Security is taxed. So Social Security, if you're single and under 25,000, there's no tax on Social Security. If you're a couple, that limit is 32,000. That's your total income. And if you are between 25,000 to 34,000 single and 32,000 to 44,000 as a couple or a married couple, right? Then you're paying up to 50% of um, taxes on up to 50% of that Social Security. So if you are over those income thresholds and you have $30,000 of Social Security, you're going to pay taxes on up to 15,000 of that 30. Hopefully that makes sense. And then if your income is above 34,000, if you're single, or 44,000 as a couple, you're going to pay up to 85% taxes on up to 85% of those benefits. So Social Security maximum tax is on the benefits is 85%. So it's not an 85% tax, it's 85% of the benefits will get taxed. And so that's a very income dependent. So I can't really give a straight answer because I don't know anything else about this person's situation who asked this question. So if that is you, feel free to chime in. And I am happy to answer questions live once I get through all the ones that were previously submitted. So the next question I got is, I'm just starting a business and I need to pay in quarterly taxes. Do I base this off of total amount of income and self-employment tax I expect to pay at the end of the year? Or do I have to pay self-employment tax as calculated based off of income for me? So I'm not really sure I understand this question, but let me just kind of understand or explain self-employment taxes. Self-employment taxes are as for a business owner. So what a business owner or a partner in a partnership would be a business owner. And self-employment tax is 15.3% of the net profit of whatever is passed through to you. So if you are 100% sole proprietor, you're going to pay 100%, right? The net profit. So if you have $5,000 of net profit, you multiply that times 15.3, and those are the self-employment taxes that you're going to pay. Self-employment tax is your Social Security and your Medicare you're going to be paying in. And when you're paying your estimated quarterly tax, you're going to be paying in for self-employment and your income tax. So that hopefully that helps answer that question. Otherwise, I'm not really sure I understand the question here. Yeah, income tax and social self-employment tax would be what you're paying in for quarterly estimated. In case you're unaware, the next quarterly estimated payment is due in a couple of weeks, September 15th. I'm also going to drop in the chat here about an article I wrote about self-employment taxes. If you're interested in checking that out, that will help clarify things. You type that in. I see a couple of people here, so welcome. I'm glad to have you here from North Alabama. Hopefully it's not too hot there. And so I hope that helps answer that question and just kind of clarify quarterly estimated are both self-employment and income tax, whatever that estimate is going to be based off of your net profit from the business, because that's what you're going to pay taxes on, along with any other things you might have going on. If you have retirement income, if you have a W-2, whatever else is going on. So I've just switched from using New Cash and I'm back to using Quicken. I had to use the personal version for more than 20 years on my Windows. Long story short, I'm now on a Mac, on Apple. Quicken stopped making Apple software. And now they're making it again. Let's see, I'm setting everything up. My question is about categorizing expenses. Which ones count and how much getting the correct category matters. So getting the correct category does matter because you have to defend it. So if something seems out of place, like if something's really high, especially for your industry or whatever, that's going to raise that red flag. And so that's why getting the category right is proper or is important. But more importantly is that you have records to document and prove all of the expenses that you've taken. So really, I guess the category isn't the most important thing. The most important thing is having the records to prove why you did what you did, why you took those expenses. So this person is struggling, to know what category goes on. So using Quicken, you have to tell it what schedule it goes on. So it doesn't, I'm going to kind of go over some of that. So I found the categories incredibly hard to do. How do I figure out what categories to use? Is there a secret book somewhere? There's no secret book. There is a list if you even look, so you can pull up a tax return. So first of all, there's different types of entity taxation, right? So if you're sole proprietor, then you're going to have a Schedule C on your tax return. If you're a partner, you're going to file a partnership tax return. So that's a 1065. If your business is an S Corp, you are going to file an 1120S. And each one of those is going to have categories. They're going to be pretty similar. And sometimes you won't see something that feels like you should have, and that's okay. You can have industry specific things and include those in your other expenses. They do have a whole other area for other expenses. So let's go into, you have a couple of examples here. Have to do continuing education. This person is a traveling doctor versus a traveling nurse. And so has continuing medical education and belongs to state medical societies as part of his licensing. He has to pay for licenses, which all make sense. Those are all legitimate business expenses. Education, continuing education, completely legitimate business expense. And they're on a Schedule C, if you're a sole proprietor, there isn't a line for that, but you can certainly create one and your other expenses. So continuing education, sometimes people call it training and education. Either one is fine. And then licensing, for sure, you can take licensing. Many businesses need licensing. I mean, I need a licensing to do my business, and that's a legitimate business expense. So those are, to me, on the easier side. But let's share this. I did write an article about this as well. And that kind of might clarify some of the expenses you can take. And then the other thing you have is related to travel. So traveling to assignments, you aren't coming from your domicile or your home. So is that a legitimate business deduction? So travel is not a legitimate business expense. So if you are full-time RV and you're traveling from one assignment to the other, you each time are basically commuting to your job. So it is not a business expense to go from point A to point B to go to a new hospital or clinic where you're going to be working. Yeah. So unfortunately, I would not take any travel for that. The only difference here is when I see a travel nurse or traveling doctor, in your case, have a home base, and that way, then you are away from your tax home because your tax home was right. You're going to go back to that home base. So let's say you have a home base, I don't know, in Ohio, right? And you know you're going to go somewhere, you're going to drive to Montana for 4 months and work a contract, but then you'll eventually return back to Ohio, in which case, then your mileage might actually be allowed. So that's really the biggest difference is when you're full-time, it's your home, that's your home. It doesn't count towards mileage. It doesn't count towards the business. So I hope that clarifies that traveling to assignments part. And that can be for any kind of work. It doesn't necessarily even need to be a travel nurse or a travel doctor, traveling electrician, other, you know, anything, any kind of consulting or whatever. Just moving from one place to another is not a legitimate business expense for travel. I hope that clarifies some of that. And if you wanted to check out that article talking about the different business expenses, I mean, just be realistic about it. It's really, you might have, in a doctor's case, you might have uniforms, right? So you need to buy scrubs or a lab coat or something, doctor's coat that might have your name on it or something like that. Those are all legitimate business expenses. And again, continuing education, um, possibly needing like a phone service to be able to reach internet service, right? To get those jobs, right? You had to be able to get that stuff. So just think of your industry and what might be necessary to do that job. It's ordinary and necessary to do the work that you're planning to do. In the case of someone who's a consultant, it might be software, definitely any kind of insurance you have for yourself for the business, malpractice insurance, whatever, liability insurance, anything related to that business to cover yourself. It can also be advertising. So if you have to pay have a website or anything like that, those are all legitimate. Those are ordinary business expenses. Next question. I hope that helps answers that question. Please reach out if you have more questions, specific deductions that you can take. I love giving examples because that helps everybody learn what works and what doesn't. Let's see. At what point should we transition our domicile to Colorado? Okay. Context. Currently, I'm a digital nomad with my husband. Our domicile is in Texas. We are in the process of buying land in Colorado. We own both businesses. Not having to pay state income tax saves us quite a lot of money. So owning land in a state doesn't necessarily give you tax obligations there. It doesn't make that your home. If you plan on living there, spending a certain amount of time there, each state's a little different in defining the time. If you're building a home and calling that your home base, for sure. I can give myself as an example. I actually have a home base in Colorado. That is my domicile. That is my state of residence at this point. Even if I'm only there 4 months out of the year, it is still my domicile. It is still where I consider home, right? So in that case, I have to pay state taxes. I'm claiming that as my home. If you just buy land and come and spend 2 or 3 months in it in the summertime and enjoy the cooler weather because maybe it's at high elevation, I would not consider you a Colorado resident and you could continue keeping that Texas domicile. I don't see that an issue. So it really just depends, are you building a home there? Is that your home base? That kind of thing. So facts and circumstances here make a huge difference. I wouldn't say that there is one specific time that you have to transition your domicile, other than if that's your home base, right? You're always going to come back to that, and you're building a house, not just land. Hope that answers that question. And again, if anyone here is live, feel free to drop in some questions. I should have a little time. Got one more previous question that I am going to go over, and otherwise I'm happy to answer some live questions. So my wife and I have been RVing for 6 years. Awesome. In early 2022, we purchased a new Ford and a fifth wheel, and my wife has had a small business. Current business is creating and selling crafts and selling them at craft shows. I have been trying to figure out how we might be able to write off our new truck and the RV as a business expense. We are not full-time, which is really important here. So I want to go over that, and I kind of touch base on this when we're talking about expenses. If you're not full-time, it's actually easier to take mileage because you have a tax home base. So again, for me, I have Colorado is my home base. So anytime I'm driving, so if I go back to Colorado, I drive from Colorado to Missouri, Kansas, I don't know, to do an art show. That would be business mileage. So you have two different things here. So you have a truck, which gets mileage. So make sure you record 100% of your mileage, 100%. So all mileage, whether it's personal or business, making sure to record what the business purpose is, and what you're going to do, whether that's meeting with somebody. In this case, it would be going and selling at a craft or art show. That's fine. Make sure to record your entire mileage. So typically what I suggest doing in this case is recording mileage either December 31st or January 1st, writing it down somewhere. I usually try to do it electronically so I don't lose it, or using an app, one way or the other. But you record your mileage, so that's the end of year mileage and the beginning, right? So you always have the end in the year and the beginning, because that's what you need. And then you're going to record all your business mileage and what the purpose was, the date, how many miles it was, right? What you were going to do, if you're going to meet with somebody, in this case, again, going to a craft show. And then you can tally that up, right? So you get to take a percentage. So you take a percentage of your business, of your total miles is business, right? So it could be 50%, that's fine. If you drive 10,000 miles in a year and 5,000 are for business, you've got 50% business use of your truck. You can take the standard mileage deduction and just take those mileage, deduct time, multiply it times the standard mileage, whatever that number happens to be. It changes annually according to the IRS, and then take that as your deduction. The other option is to take actual expenses. And so you still need your mileage because now you're taking 50% of all your expenses. So you now need to record insurance, registration, any kind of maintenance, oil change, new tires, you name it. All expenses, fuel, and you get to take 50% of that. You also get to take depreciation on the truck, 50% depreciation. So there's two different methods. I typically will see the standard mileage deduction easier and often higher. In this case, it may be the case better to take the depreciation on the truck because trucks are expensive. I know that. But it's an individual basis. That's what I would just work with you on that to determine. That's really the factor there. So that's the truck, right? We're talking about mileage. That's clear. And the RV is a totally different thing. So the RV is an asset to the business, possibly, right? It might actually be 100%. I rarely see 100% for business use, because anytime you go and stop, so like if you were driving to a state and you stopped and enjoyed some time somewhere, right? That's personal use. So it's a very gray area. And I would normally never suggest taking 100% of an RV. It would have to be really, really rare circumstances when I would say 100%, but it's possible. But even if you take 50 or 75%, because you're using that RV to go to these to craft shows and art shows and sell for your business and storing some of the goods in there, right, as you're traveling, just be careful, because it can be skewed in saying like you're living in the RV, right? It's not just being used as a hotel, and there's personal use there. So I just be cautious here, but I think 50, to 75% would make sense if that's really all you're using it for. If you're taking it out and going to visit national parks or to visit your kids in a certain state, those are all personal use. and they would not count towards business. So I hope this is giving some clarity. If you are online here and want further questions, or want, further answers rather, you have further questions, please reach out or just type it in here in comments in the chat. So that's really how I would suggest it. Again, you have two different things going on. So you've got your mileage for the truck, and then you've got your asset, which is the RV. So two separate things. And the RV gets to be depreciated. So that's what I'm talking about when you get to take 50% of it. So if the RV cost you $50,000, you're using it 50% for business, you can depreciate $25,000. Hope that's clear. I actually just had an article. I get lots of questions about the mileage, and so I just wanted to share that in here as well. So that might help as well as far as taking mileage. Just wrote that in August because I get so many questions between the difference of that standard mileage and taking actual expenses. And yeah, hopefully that gives some clarity. Those are all the questions that I got submitted previously. If anyone is here live, feel free to jump in here and ask a question. I'll stay on for another minute or two if anyone has anything live. Otherwise, I'm going to sign off, and I wish you a great September and a great fall. The next Tax Tuesday is October 1st. It's always 10 a.m. Mountain Time. So October 1st, the first day of the month, happens to fall on a Tuesday. And yeah, you're welcome, Rob. That must have been, one of these must have been your question. I don't keep the names of who submits the questions because I like them to sort of be anonymous. And I hope that was helpful. I'm glad that was helpful, actually. You said yes. So yeah, otherwise have a great September, and I'll see you October 1st, 10 a.m. Mountain Time. Thanks everyone for joining me, and have a great month.